It's not your IQ score, it's not the university degree hanging on your wall, or the complex financial models you can build in a spreadsheet. According to the man who has compounded wealth at a rate that defies financial gravity for over half a century, the single most important quality for an investor, the one trait you need to beat the market, has almost nothing to do with intellect. Warren Buffett has stated, time and again, that once you have an ordinary level of intelligence, what you need is temperament. The emotional stability to be disciplined when the world is chaotic, to be patient when the world demands action, and to be rational when the world is swept away by emotion. This isn't just a quaint piece of advice. It is the core operating principle behind the greatest wealth creation engine in history. The average investor, a person who is often incredibly intelligent in their own field, a doctor, a lawyer, an engineer, consistently underperforms the market averages. Why? Because they let the two great imposters, fear and greed, pilot their financial ship. They buy high in moments of euphoria, caught up in the madness of crowds, and they sell low in moments of panic, liquidating their future to quiet a temporary fear. They turn their greatest potential asset, their own mind, into their greatest liability. Today, we deconstruct this principle. We will transform your understanding of what it takes to succeed, not just in the market, but in any high-stakes decision-making environment. We will explore the 5 pillars of a market-beating temperament, turning abstract concepts into actionable blueprints for your own life. You will learn that you can control the single most important variable for your success. This is not about being smarter than everyone else. It is about being more disciplined than yourself. This is the key to unlocking a lifetime of portfolio growth, to achieving genuine financial freedom, and to finally silencing the emotional noise that has held you back. This is the final promise of rational investing. Our first pillar, the very bedrock of a successful investment temperament, is a concept that feels alien in our hyper-accelerated world: patience. But this isn't a passive, gentle waiting. It is an active, predatory patience. It is the discipline of inaction, the strength to sit on cash for years, waiting for the perfect pitch. And there is no greater story to illustrate this power than Warren Buffett's masterful navigation of the great salad oil scandal of 1963. To understand the genius of this move, you must first feel the panic of the moment. The setting is American Express, a titan of American finance. It wasn't just a credit card company. It was a symbol of trust. Its travelers' checks were considered as good as cash anywhere in the world. Its reputation was pristine, its business model seemingly invincible. A significant, though not primary, part of their business was in warehousing. They would store goods for companies and issue receipts for those goods. Other banks would then lend money to those companies, with the American Express receipts as collateral. It was a mundane, profitable business built entirely on trust. But that trust was about to be shattered by a man named Tino DeAngelis and his company, Allied Crude Vegetable Oil. DeAngelis was a master fraudster. He had discovered that he could fill his massive storage tanks mostly with water, with only a thin layer of valuable soybean oil on top. Inspectors would measure the oil from the top and sign off. On these fraudulent inventories, American Express's warehousing division issued receipts. Banks, trusting the American Express name, lent DeAngelis millions upon millions against this phantom oil. In November of 1963, the House of Cards collapsed. The scandal broke, and it was cataclysmic. Allied Crude Vegetable Oil filed for bankruptcy, owing banks over $175 million, a staggering sum at the time. The collateral, the millions of pounds of salad oil, wasn't there. And whose name was on the receipts that guaranteed it was? American Express. Wall Street panicked. The herd thundered. The question was simple and terrifying. Was American Express liable for the fraud? Would they have to cover the massive losses? The stock plummeted. It was cut in half in a matter of weeks. The narrative was one of doom. Respected analysts, the so-called experts, declared that the company's reputation was irreparably damaged. No one would ever trust an American Express traveler's check again. The brand, its most valuable asset, was now its greatest liability. This was the epitome of a crisis, a moment of maximum fear and uncertainty. And while the rest of the investment world was selling in a frenzy, Warren Buffett, then running his small investment partnership in Omaha, did something radical. He got curious. He didn't listen to the noise on Wall Street. He didn't read the panicked newspaper headlines and rush to a conclusion. He engaged in what he called investigative work. He went to the source. He started visiting local restaurants in Omaha. He'd sit down, talk to the owners, and observe customers. He wanted to know, were people still using American Express cards? Were they still paying with American Express traveler's checks? The answer was a resounding yes. The scandal, it seemed, was a Wall Street story, a high-finance drama. For the average person, the brand's utility was unchanged. He then went to local banks and talked to the tellers. Were they still selling traveler's checks? Were people still treating them like gold? Again, the answer was yes. He even spoke with competitors and travel agencies. The data on the ground, the reality of the business, was completely disconnected from the panic in the stock market. He concluded that the fundamental business, the consumer-facing powerhouse, was unharmed. The warehousing division was a problem, but it was a survivable one. He determined that the company's ultimate liability would be far less than the market feared, and that the core brand, the true engine of value, was intact. So, with this deep first-hand conviction, he acted. He invested 40% of his entire partnership's capital into American Express stock. 40%. It was an act of supreme confidence born not of arrogance but of patient, diligent research. He didn't just buy a little, he swung for the fences when he saw the perfect pitch. And then, he waited. He was patient. He allowed the market's panic to subside. He allowed the company to settle its legal issues. And over the next few years, as the truth emerged and the company's powerful earnings engine continued to hum, the stock price recovered and then soared. Buffett's partnership made a fortune, turning a $12 million investment into a multi-bagger that would form a significant part of his early success. This story is the foundational anecdote for patience because it reveals its true nature. It is not just waiting, it is preparing. It's the discipline to do the hard work of analysis when everyone else is reacting emotionally, and then having the courage to do nothing until the opportunity becomes so obvious, so compelling, that the decision is easy. The power of this patient approach is rooted in its direct opposition to some of our most deeply ingrained psychological biases. The primary culprit is a cognitive flaw known as hyperbolic discounting. In simple terms, our brains are hardwired to value immediate rewards far more highly than future rewards, even if the future rewards are substantially larger. This is an evolutionary hangover. For our ancestors on the savannah, finding a berry bush was an immediate reward that meant survival today. The promise of a larger berry bush a week's journey away was uncertain. It was better to take the sure thing now. This instinct is still alive and well within our modern skulls, and it is catastrophic for effective long-term investing. The thrill of a small, quick gain from a hot tech stock feels more potent and real to our primal brain than the abstract concept of a massive nest egg 30 years from now. Hyperbolic discounting is why people choose to spend rather than save, and why investors find it so difficult to hold a great company through a period of market volatility. The immediate relief of selling to stop the pain is a powerful siren song, drowning out the logical promise of a much larger future gain. Compounding this is the action bias. We feel a deep-seated need to do something, especially in situations of high stress or uncertainty. Inaction feels like negligence. When the market is crashing, our brain screams at us to sell, to trade, to reposition, to act. Sitting still and doing nothing feels irresponsible. Yet, in investing, often the most profitable action is no action at all. Warren Buffett's genius in the salad oil scandal was overriding this bias. The market was screaming, "Act! Sell! Get out!" But his temperament, fortified by his research, allowed him to do the opposite, to wait, to analyze, and then to act decisively in the other direction. This behavioral finance concept explains why the investment industry is built around activity. Financial news networks thrive on the action bias, creating a constant sense of urgency. Brokerage firms make money on transactions, incentivizing you to trade more, not less. The entire ecosystem is designed to prey on your innate psychological compulsion to do something. A patient temperament is the shield against this manipulation. It allows you to step outside the frantic cycle of action and reaction. It recognizes that the market's daily gyrations are mostly noise, not signal. True wealth building isn't about constant activity. It's about making a few very good decisions over a lifetime, and then letting the power of compounding do the heavy lifting. Mastering this aspect of investment psychology means rewiring your brain's reward system. You must learn to derive satisfaction not from the thrill of the trade, but from the quiet confidence of sticking to your plan. You must train yourself to see inaction not as passivity, but as a strategic choice, a position of strength. This is the cerebral battle that every great investor must win. They must conquer the ancient, impulsive parts of their brain with the modern, rational ones. They must trade the sugar rush of hyperbolic discounting for the deep, nourishing meal of long-term compounding. So how do we translate this understanding into a practical tool? How do we build a system that forces us into this state of predatory patience? Warren Buffett himself provided the blueprint with a powerful mental model, the 20-slot punch card. Imagine that at the beginning of your investment career you are handed a punch card with only 20 slots in it. That's it. 20 punches for your entire life. Every time you make an investment decision, buying a stock, an index fund, a piece of real estate, you have to punch one of those slots. Once the 20th slot is punched, you can't make any more investments. Think about how that would radically alter your behavior. You would stop chasing frivolous tips. You wouldn't waste a precious punch on a speculative bet or a company you didn't understand deeply. The constant temptation to trade in and out of positions would evaporate. Each decision would be treated with the gravity it deserves. You would be forced into a state of extreme selectivity. This mental model is a practical instruction manual for cultivating patience and improving your risk management. Here is the step-by-step process to apply it to your own financial life. First, formally adopt the mindset. Write it down. I have a 20-slot punch card for my major investment decisions. Put this somewhere you will see it often, perhaps inside the cover of a journal where you track your investment theses. This act of writing it down makes it a real commitment, engaging your commitment and consistency bias in a positive way. Second, define your circle of competence with brutal honesty. What industries and business models do you truly understand? Not what's popular, not what you've heard about, but what you can explain to a 10-year-old. Your punch card can only be used on investments that fall squarely within this circle. This immediately eliminates 99% of the opportunities that the market will throw at you, simplifying your focus and reducing decision fatigue. Third, for any potential investment that falls within your circle, you must create a detailed, one-page written thesis. Why is this a great business? What is its durable competitive advantage? Who are the managers and are they trustworthy? What are the primary risks? And most importantly, what is a price that would make this investment a no-brainer? A price so attractive that it offers a significant margin of safety. This process forces deep thought over impulsive reaction. It transforms you from a stock picker into a business analyst. Fourth, and this is the hardest part, you wait. You have your list of wonderful businesses and your no-brainer prices. Now you let the market do the work. You wait for the inevitable moment of panic, the bad earnings report, the sector-wide downturn, the salad oil scandal moment for your chosen company that brings the price down to your predetermined entry point. This is no longer passive waiting, it is active hunting. You know what you're looking for, and you have the discipline to wait for it to appear. Fifth, when the price hits your target, you consult your punch card. Is this truly one of the 20 best ideas you will have in your lifetime? If the answer is a resounding yes, you act with conviction, just as Buffett did. You don't just dip a toe, you make a meaningful investment. because you've done the work and have the confidence to back it up. Using the 20-slot punch card mental model is a profound act of self-improvement. It is a system that forces financial discipline, prevents emotional investing, and aligns your actions with a successful long-term investing strategy. It is the practical application of patience. To truly appreciate the power of this patient, disciplined approach, we must dedicate some time to exploring its antithesis, the path of the 99%. This is the path of constant activity, of emotional reaction, and ultimately of financial self-sabotage. The archetype of this path is the hyperactive trader. Their day begins not with a coffee and a business journal, but with the frantic glow of pre-market futures. They are glued to financial news, their emotional state rising and falling with every tick of the Dow Jones Industrial Average. Their vocabulary is one of urgency, momentum, breakouts, catching the move. They believe that success in the market is a function of speed and activity. They are constantly looking for the next hot tip, be it from a cable news personality screaming about a disruptive technology, or a faceless avatar on a Reddit forum promising a short squeeze to the moon. Their process is purely reactive. They see a stock that has gone up 100% in a month, and their dominant emotion is not skepticism, but fear of missing out, FOMO. They pile in near the top, providing the liquidity for the early, smart investors to cash out. Then, when the story changes and the stock begins to fall, their dominant emotion switches from greed to fear. Their shallow conviction, based on nothing but price momentum, evaporates. They sell, often at a significant loss, vowing never to make that mistake again, only to repeat the exact same cycle with the next shiny object that comes along. This isn't a caricature. It is the documented behavior of millions of investors during every market cycle. Think of the dot-com bubble in the late 1990s. People with no understanding of technology or business were quitting their jobs to become day traders, convinced that companies with no profits and no plausible business model were the future. They ignored fundamentals and chased eyeballs, clicks, and narratives. The result was the destruction of trillions of dollars of capital. More recently, consider the meme stock craze of 2021. The narrative of us versus them created a powerful emotional pull, but it was untethered from the fundamental reality of the businesses involved. Many bought at the peak, fueled by social media hype, and were left holding the bag when the speculative fervor inevitably died down. This behavior is the antithesis of the 20-slot punch card. It is a million-slot approach, where every idea is acted upon, every whim is indulged, and every emotion is allowed to dictate financial decisions. This path is seductive because it feels like you're in control. You're busy, you're making moves, you're engaged, but it is the illusion of control. In reality, you have surrendered control to the most volatile and unreliable forces in the universe, market sentiment, and your own primal emotions. This is the essence of poor trading psychology. It is a constant search for shortcuts to wealth, a belief that you can outsmart the market through sheer activity. But the market is a brutal teacher, and the lesson it consistently teaches is that patience and discipline are not just virtues, they are prerequisites for survival and success. The path of the 99% is paved with transaction costs, high taxes from short-term gains, and the devastating, unrecoverable losses that come from buying high and selling low. It is a recipe for transforming the dream of wealth building into a nightmare of capital destruction. The direct financial connection between patience and wealth is not a matter of opinion. It is a mathematical certainty. Its name is compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world, and for good reason. It is the engine that turns modest savings into fortunes, but it has one non-negotiable requirement: time, an uninterrupted runway of time. Every time an investor succumbs to impatience, by selling a great company during a downturn or by constantly trading in and out of positions, they are committing a cardinal sin against compounding. They are chopping down the oak tree to sell it for firewood when, if left to grow, it could have produced a forest. Let's quantify this. Imagine two investors, patient Paul and active Adam. Both start with $100,000 and are skilled enough to find investments that can generate an average annual return of 10%. Patient Paul buys a portfolio of wonderful businesses and, channeling his inner Buffett, does almost nothing. He holds his investments through market ups and downs, allowing his capital to compound uninterrupted. Active Adam, on the other hand, follows the path of the 99%. He trades frequently, chasing hot trends. His constant activity incurs, let's say, an average of 2% per year in extra transaction costs and taxes. Furthermore, his emotional investing, buying after a stock has run up and selling after it has fallen, shaves another 2% off his potential returns. So his net return is 6%. After 10 years, Patient Paul's portfolio, compounding at 10%, is worth over $259,000. Active Adam's portfolio, compounding at 6%, is worth about $179,000. The difference is significant, about $80,000. But the magic happens over the long term. After 30 years, Patient Paul's portfolio has grown to over $1.74 million. Active Adam's portfolio is worth just under $575,000. The gap has exploded to over $1.1 million. Paul is well on his way to financial freedom, while Adam is far behind. Despite starting at the same place with the same initial skill, the difference was not intellect. It was temperament. Patience created a massive, tangible financial advantage. Patience allowed the exponential growth curve of compounding to work its magic. On a company's balance sheet, the value of patience is reflected in the growth of retained earnings. A great company that can reinvest its profits at high rates of return becomes a compounding machine. As an investor, your job is simply to own it and let the management do the work. By constantly trading, you are betting that your ability to time the market is greater than the company's ability to compound its own value. This is a losing proposition for almost everyone. The financial discipline of patience, therefore, is not about being lazy. It is about recognizing where the true value is created. It is created inside great businesses over long periods of time. The financial connection is direct and powerful. Patience protects the compounding process, minimizes value-destroying costs, and allows you to be the beneficiary of long-term business growth rather than a victim of short-term market speculation. The second great pillar of a market-beating temperament is discipline. If patience is the art of waiting for the right pitch, discipline is the strength to not swing at the bad ones, no matter how tempting they seem or how loudly the crowd is cheering for you to swing. It is the creation and unwavering adherence to a rational framework, a set of rules that governs your behavior and insulates you from emotional error. The most powerful illustration of financial discipline in Warren Buffett's career is not a story of a brilliant purchase, but of a courageous refusal. His decision to abstain from the dot-com bubble of the late 1990s. The context of that time is difficult to overstate for those who didn't live through it. It was a period of wild, unadulterated euphoria. The internet was new, and it was going to change everything. A new paradigm had arrived, and the old rules of valuation of profits of tangible assets were declared obsolete. Companies with names like Pets.com, Webvan, and TheGlobe.com were coming to market with billion-dollar valuations without ever having earned a single dollar of profit. In many cases, they had no clear path to ever earning one. It was a gold rush, and everyone was getting rich. Stories were rampant of secretaries becoming millionaires overnight on tech stock IPOs. The social pressure to participate was immense. And in the middle of this frenzy stood Warren Buffett, the Oracle of Omaha, looking like a relic. He was publicly and often mockingly criticized. His discipline was framed as stubbornness, his prudence as senility. In 1999, the financial magazine Barron's ran a now infamous cover story with his picture on it, titled, "What's Wrong, Warren?" The article detailed his failure to adapt, his refusal to buy the high-flying tech stocks that were making everyone else a fortune. Berkshire Hathaway's stock was underperforming the market, and investors were questioning if the old man had lost his touch. Imagine the internal fortitude required to withstand that. Every day, you turn on the television and see people half your age, with a fraction of your experience, becoming fabulously wealthy in a sector you've chosen to ignore. Your own shareholders are restless. The media, the supposed arbiters of financial wisdom, are calling you a dinosaur. It would have been so easy to capitulate. He could have bought just a few tech stocks to appease the critics, to show he was getting with the program. But Buffett's discipline was absolute. It was anchored in a simple but powerful rule that formed the core of his investment philosophy, the circle of competence. He would only invest in businesses he could understand. He understood insurance, consumer goods, banking, and newspapers. He did not, by his own admission, understand the technology or the long-term competitive dynamics of these new internet companies. He couldn't confidently predict what they would look like in 10 or 20 years, and if he couldn't understand them, he wouldn't invest, period. He was willing to accept the opportunity cost of missing out on some winners in order to protect himself from the catastrophic risk of investing in something he didn't comprehend. His discipline was not based on a prediction that the bubble would burst. It was based on a humble admission of his own limitations. And then, in March of 2000, the bubble did burst. The Nasdaq index, a proxy for the tech sector, began a brutal decline, ultimately falling nearly 80% from its peak. The high-flying companies that had been the darlings of the new economy went bankrupt in droves. Trillions of dollars of speculative wealth were vaporized. And Warren Buffett, who had looked so foolish in 1999, looked like a genius in 2001. His discipline had preserved Berkshire's capital during one of the greatest market manias in history. When the dust settled, he had a mountain of cash ready to deploy into the wonderful old economy businesses that had been sold off in the panic. This anecdote is the ultimate testament to discipline. It is the ability to stick to your process, your rules, and your principles, even when it's painful, even when you're suffering from social ridicule, and even when it feels like you're missing the party of a lifetime. It is the fortress that protects your capital from the seductive but ultimately destructive madness of crowds. The psychological principle that makes such discipline both incredibly difficult and supremely powerful is the concept of commitment and consistency. Humans have a deep-seated psychological need to be consistent with things we have previously said or done. Once we make a choice or take a stand, we encounter personal and interpersonal pressures to behave consistently with that commitment. Buffett masterfully uses this bias to his advantage. By publicly stating his simple, clear rules, like staying within his circle of competence, he creates a powerful psychological barrier against temptation. To violate his rule would be to create cognitive dissonance, a state of mental discomfort. His public commitment to his process makes it easier for him to remain consistent, even under extreme pressure. This is a form of self-control architecture. He is not relying on pure willpower, which is a finite resource. Instead, he is building a system of commitments and principles that make the desired behavior, discipline, the path of least psychological resistance for him. At the same time, discipline serves as the ultimate antidote to one of the most dangerous biases in investing: herd mentality or social proof. Our brains evolved to find safety in numbers. If everyone in the tribe was running away from a certain part of the forest, it was a good survival strategy to run with them, not to wander over and see what the danger was. In the modern world of investing, this instinct is a liability. When everyone is piling into tech stocks, our brains tell us they must know something we don't. The desire to conform is overwhelming. Discipline, in the form of a pre-committed set of rules, acts as a circuit breaker for this instinct. When the herd is stampeding towards a cliff, your rules are the anchor that holds you back. Your thought process becomes, does this action conform to my rules? Not, what is everyone else doing? This shift in framing is the essence of a professional mindset versus an amateur one. The amateur is driven by social cues and emotion. The professional is driven by process and rules. A disciplined investor understands that the market is a chaotic environment designed to provoke emotional responses. The only way to navigate it successfully over the long term is to subordinate those emotions to a rational, pre-established framework. This is the core of financial discipline. It is the conscious decision to follow a plan rather than a whim. It is an understanding that in the battle for investment survival, a good plan that you stick to is vastly superior to a brilliant plan that you abandon at the first sign of trouble. This aspect of investment psychology is about building a defense. Before you ever think about a fence, about what stocks to buy, you must first build the psychological and procedural fortress that will protect you from yourself. How can you build this fortress of rules in your own life? The most effective applied mental model for instilling discipline is the creation of an investor policy statement, or IPS. Think of this as your personal constitution for investing. It is a written document created by you during a calm and rational moment that dictates how you will behave during future moments of chaos and emotion. Its power lies in its pre-commitment. You are making decisions for your future, emotional self, while your rational self is in control. Here's a step-by-step blueprint for creating your own IPS. Step 1. Define your philosophy and goals. In a few clear sentences, write down your core investment beliefs. Are you a passive index fund investor? A deep value dividend investor? A growth at a reasonable price investor? Be specific. Then, clearly state your goals. Are you investing for retirement in 30 years? A down payment on a house in 7 years? Your time horizon will dictate everything else. This is your mission statement. For example, my goal is long-term wealth building for financial freedom in 25 years. I believe this is best achieved by owning a diversified portfolio of high-quality businesses and holding them for the long term. Step 2. Define your asset allocation. Based on your goals and your honest assessment of your own risk tolerance, determine your target allocation to different asset classes like stocks, bonds, and cash. For instance, my target allocation is 80% global equities and 20% short-term bonds. I will rebalance my portfolio once a year on my birthday if any allocation deviates by more than 5% from its target. This simple rule prevents you from panic selling stocks during a crash and forces you to buy more when they are cheap. Step 3. Define your security selection criteria. This is your circle of competence rule. What specific, measurable criteria must a company meet before you will even consider investing in it? This could include things like a minimum return on equity, a maximum debt-to-equity ratio, a history of consistent dividend payments, or qualitative factors like a strong brand and a simple business model. Write these down as a checklist. No company gets your capital unless it checks every box. Step 4. Define your buy and sell rules. This is crucial for removing emotion. Your buy rule could be, I will only purchase a stock from my pre-approved watch list when it is trading at least 25% below my calculated intrinsic value. Your sell rule is even more important. It should not be based on the stock price, it should be based on the business. For example, I will only sell a stock if 1. The fundamental reason I bought it has changed for the worse. 2. I have found a demonstrably better investment opportunity, accounting for taxes. 3. The stock becomes dangerously overvalued, trading at more than double my estimate of its intrinsic value. Step 5. Write it, print it, and sign it. This is not a digital document. It should be a physical artifact. The act of signing it creates a powerful psychological commitment. Place this document in a drawer. The next time the market is in turmoil, whether it's a euphoric bubble or a terrifying crash, your first action must be to take out your IPS and read it before you do anything else. This document is your anchor. It is the voice of your rational self speaking to your panicked future self. It is the ultimate tool for enforcing financial discipline and is a cornerstone of professional risk management. The path of the 99% stands in stark contrast to this disciplined, rules-based approach. It is a path defined by style drift and the constant abandonment of any coherent strategy. Style drift is one of the most common and destructive behaviors in investing. It happens when an investor, who may even have a sound initial strategy, abandons it in favor of whatever is currently working in the market. Consider the value investor. Their strategy is to buy boring, unloved companies at cheap prices. This strategy works beautifully over the long term, but it goes through periods of underperformance. During a tech bubble, while growth stocks are soaring, the value investor's portfolio might be flat or even down. The undisciplined value investor begins to feel immense pressure. They feel foolish. Their friends are getting rich on .com stocks, so they start to rationalize. Maybe I need to be more flexible. This time it's different. I need to get some exposure to technology. They abandon their time-tested, disciplined approach and start buying the very same overpriced speculative stocks they once disdained. They inevitably buy near the top, just as the cycle is about to turn. Then, when the bubble bursts and value investing comes back into favor, they are no longer positioned to benefit. They have sold their cheap, solid companies to buy expensive, speculative ones at the worst possible time. This happens in every cycle. The dividend investor starts chasing capital gains. The long-term buy-and-hold investor starts day trading. They drift from strategy to strategy, always one step behind the market, always chasing yesterday's winners. The psychological root of this is a lack of deep conviction in one's own process. If your strategy is just something you read in a book or heard from an expert, it is not truly yours. You haven't done the deep work to internalize its logic. As a result, when the strategy is tested by the market, and every strategy will be tested, your conviction shatters. You abandon ship and swim towards the nearest, most crowded lifeboat, which is usually just another sinking ship in disguise. The 99% follow performance. The disciplined 1% follow a process. The path of style drift is a guaranteed route to underperformance. It combines the worst of all worlds. You buy high because you're chasing what's popular, and you sell low because you're abandoning what's unpopular just before it recovers. It is a perfect recipe for emotional investing, ensuring that you are always reacting to the market's mood rather than executing a sober, long-term plan. This lack of discipline turns a potential wealth-building journey into a chaotic and costly random walk. The direct financial connection of discipline is stark and can be summed up in 2 words: loss avoidance. While a brilliant investment idea can make you a lot of money, a single catastrophic mistake driven by a lack of discipline can wipe you out entirely. The primary financial benefit of a rules-based approach is not that it guarantees you will pick winners, but that it systematically prevents you from making the kind of fatal errors that permanently impair your capital. By refusing to invest in the .com bubble, Warren Buffett's discipline didn't just help him underperform on the way up, it preserved 100% of his capital on the way down. While others saw their portfolios cut by 50, 60, or even 80%, Buffett's capital base remained intact, ready to be deployed at the bottom of the market. The math of losses is brutal. If your portfolio falls by 50%, you need a 100% gain just to get back to even. The bigger the loss, the more extreme the required recovery becomes. Discipline is the gatekeeper that prevents these crippling losses. Your rule to stay within your circle of competence prevents you from gambling on speculative ventures you don't understand. Your rule on valuation prevents you from overpaying for assets during a mania. Your rule on diversification prevents you from concentrating your entire net worth in a single high-risk bet. Each rule is a financial firewall. On a balance sheet, this discipline translates to stability. A disciplined company avoids taking on excessive debt, it avoids reckless, empire-building acquisitions, and it focuses on steadily increasing its intrinsic value year after year. As an investor, your portfolio should reflect the same principles. The financial advantage of discipline is that it keeps you in the game. Compounding can only work its magic on capital that exists. By avoiding the big mistakes, by protecting your principal from the ravages of your own emotional impulses, you ensure that your wealth-building machine is never sent back to the drawing board. It is the steady, unglamorous, but ultimately unstoppable force that underpins all long-term investing success. Discipline is the governor on your financial engine, preventing you from redlining into a catastrophic explosion and ensuring you have the fuel to complete the entire journey. This leads us to the 3rd pillar of a superior temperament, the one that allows you to act when patience and discipline have set the stage: rationality and independent thought. It is the ability to detach from the prevailing narrative, to see reality clearly when everyone else is mesmerized by a mirage, and to act on fact, not on feeling. It is perhaps the loneliest and most difficult trait to cultivate. The quintessential story of Buffett's independent thought is his 1973 investment in the Washington Post Company. The context was bleak. In the early 1970s, the market was in a brutal bear market. Economically, the country was struggling with stagflation. And institutionally, the press was under attack from the Nixon administration due to its reporting on the Watergate scandal, with the Washington Post at the epicenter of the controversy. The mood on Wall Street towards newspaper stocks, and especially the Washington Post, was overwhelmingly negative. The narrative was that television was the future and newspapers were a dying industry. The political pressure from the White House was seen as a direct threat to the company's business. Analysts and fund managers were dumping the stock in droves. The price had been hammered, falling by nearly half. The entire company, with its flagship newspaper, Newsweek magazine, and several profitable television stations, was being valued by the market at a mere $80 million. To the crowd, it was a melting ice cube in a politically fraught industry. But Warren Buffett, sequestered in Omaha far from the noise of Wall Street, saw a completely different reality. He wasn't listening to the story. He was reading the numbers and analyzing the business. He knew that Katharine Graham, the company's leader, was a manager of immense integrity and courage. He ignored the narrative about newspapers dying and focused on the tangible reality of the Washington Post's competitive position. In a city like Washington, D.C., it was the dominant, essential source of information. It had what he would later call a moat, a durable competitive advantage. It was a local monopoly on information that allowed it to have immense pricing power with advertisers. He looked at the television stations the company owned and saw they were virtual licenses to print money. He calculated that the television stations alone were worth more than the entire $80 million price tag the market was putting on the company. In effect, he could buy the TV stations and get the Washington Post and Newsweek for free. While the world was panicking about Watergate and the death of print, Buffett was rationally assessing the underlying assets and cash flows. He saw a phenomenal business trading at a ridiculous price. His thinking was completely independent of the prevailing sentiment. So he started buying, aggressively. Over the next year, he invested over $10 million, acquiring more than 10% of the company. The establishment was baffled. Here was this investor from the Midwest buying a hated stock in a hated industry at the height of a political and economic storm. But Buffett was not buying the stock market. He was buying a piece of a wonderful business that he understood. His independent analysis gave him the conviction to be greedy when others were fearful. The result is now legendary. The Washington Post Company became one of Berkshire Hathaway's most successful investments of all time. That $10 million investment would eventually become worth over $1 billion, a 100-fold return. This was not luck. It was the direct result of a temperament that could isolate itself from the emotional contagion of the market, think rationally from first principles, and act with conviction based on its own independent conclusions. The psychological battleground where this kind of independent thought is won or lost is defined by two powerful biases: social proof and the authority bias. Social proof, as we've touched on, is our tendency to assume that the actions of others reflect the correct behavior for a given situation. If everyone is selling a stock, our brain interprets this as a signal that something is wrong with the company. It takes significant cognitive effort to override this and ask, is the crowd right, or are they panicking? The authority bias is our tendency to attribute greater accuracy to the opinion of an authority figure and be more influenced by that opinion. In finance, the authorities are the famous analysts on television, the columnists in financial newspapers, and the high-profile fund managers. When these figures are all saying the same thing, it becomes incredibly difficult to hold a contrary opinion. Buffett's entire intellectual framework is designed to combat these two biases. He famously insulates himself from the noise, working in Omaha, thousands of miles from Wall Street. He says he doesn't read analyst reports or listen to market forecasts. He wants his analysis to be pure, based only on the business's financial statements and his own understanding of its competitive position. The key to his method is the cultivation of what he calls an inner scorecard. An individual who operates with an outer scorecard bases their sense of self-worth and the correctness of their decisions on the approval of others. They need the market to agree with them. They need the experts to validate their choices. When the crowd turns against them, their conviction crumbles because its foundation was external. An individual with an inner scorecard, however, judges themselves by their own internal standards. Their satisfaction comes from knowing they ran a rational process, did the research, and acted according to their principles. The market's opinion is irrelevant to their assessment of their own decision. They can hold a stock for years while it goes down, confident in their own analysis, as long as the underlying business fundamentals remain intact. The Washington Post investment was the ultimate inner scorecard decision. By every external metric, pundit opinion, stock price momentum, popular narrative, it was a bad decision. But on Buffett's inner scorecard, it was a brilliant one. He had adhered to his process. He found a wonderful business with a durable moat, run by honest managers, available at a price that offered a massive margin of safety. That was all that mattered. Cultivating this mindset is a profound act of self-improvement. It requires you to have the intellectual humility to know what you don't know, but also the intellectual courage to stand by what you do know, even if you're the only one standing. It's about shifting your goal from being popular to being right, understanding that in the long run of investing, the two are rarely the same. To make this concept of independent thought a practical tool, we must turn to Buffett's own teacher, Benjamin Graham, and his masterful mental model, the allegory of Mr. Market. This is perhaps the single most important concept in all of behavioral finance, a blueprint for maintaining your rationality in an irrational world. Graham asks you to imagine that you are a silent partner in a private business. Your partner is a fellow named Mr. Market. He is a very obliging partner. Every single day, without fail, he comes to your office and tells you what he thinks your shares are worth, and he offers to either buy your shares from you or sell you his shares at that price. The catch is that Mr. Market is a manic depressive. Some days, he shows up in a state of wild euphoria. He sees nothing but blue skies ahead for the business. On these days, he quotes a ridiculously high price for your shares. Other days, he is inconsolably pessimistic. He is convinced that the business and the world are headed for ruin. On these days, he quotes a price that is absurdly low, offering to sell you his shares for a fraction of their real worth. This allegory is a genius reframing of the stock market. A rational person would not let this lunatic's daily mood swings dictate their own opinion of the business's value. You would not sell out to him when he is euphoric and overpaying unless you wanted to. You would certainly not sell your shares to him when he is in the depths of despair, offering you pennies on the dollar. You would, however, be delighted to buy his shares from him when he is in his pessimistic funk. The mistake most investors make is that they allow Mr. Market's mood to inform their own. They feel rich when he is euphoric and poor when he is depressed. They let his quotes dictate their actions. The mental model provides a clear, step-by-step process for using Mr. Market to your advantage. Step 1. Do your own homework. Before you ever listen to Mr. Market's quote, you must have your own, independently derived estimate of the business's intrinsic value. This is your anchor of rationality. Step 2. Listen to his offer. Every day, the stock market, Mr. Market, offers you a price, but you must view it not as a verdict on the company's value, but merely as a transaction offer from a moody partner. Step 3. Compare the offer to your value. Is Mr. Market's price today far above your estimate of intrinsic value? If so, you might consider selling to him. Is his price far below your estimate? If so, this is a wonderful opportunity to buy from him. Step 4. Ignore him the rest of the time. If his price is somewhere in the middle, in the zone of reasonable value, you do nothing. You simply thank him for the quote and go about your day. You are not obligated to trade with him. You are in control. This mental model transforms you from a passive victim of market volatility into an active exploiter of it. The market's irrationality, its wild swings between fear and greed, cease to be a threat and instead become your single greatest source of opportunity. This is the practical application of independent thought, the true secret to beating the market. You don't do it by predicting Mr. Market's moods, you do it by profiting from them. The antithesis to this rational, independent mindset is the path of the 99%, the path of the narrative follower. This investor outsources their thinking entirely. Their analysis consists of consuming the stories and narratives peddled by the financial media and the investment community. They don't invest in businesses, they invest in stories. In the late 1990s, the story was the new economy. In the mid-2000s, it was you can't lose money in housing. In more recent years, it's been stories about disruptive innovation or the future of crypto. These narratives are powerful and seductive. They provide a simple, easy-to-understand reason why a particular asset class has to go up. The narrative follower embraces these stories because they absolve them of the need to do the hard work of independent analysis. It's much easier to believe a compelling story than it is to read a 10K report and analyze a balance sheet. The danger is that these narratives almost always gain maximum traction at the peak of a bubble. The media amplifies the story, which attracts more buyers, which pushes prices higher, which proves the story is true, creating a self-reinforcing feedback loop. The narrative follower, driven by social proof and authority bias, inevitably buys at the point of maximum excitement and maximum risk. Their conviction is not rooted in a deep understanding of the underlying asset, but in the popularity of the story surrounding it. Consequently, when the narrative breaks, as it always does, and the price begins to fall, their conviction shatters. They have no anchor of intrinsic value to hold onto. All they know is that the story that made them feel smart and safe is now causing them pain and loss. Their only recourse is to panic and sell, often crystallizing a massive loss. This behavior is a form of intellectual laziness that has devastating financial consequences. The narrative follower is perpetually a day late and a dollar short. They are the person who bought the Washington Post stock from Warren Buffett at a much higher price years later, not because they understood the business, but because the new narrative was, Warren Buffett is a genius and this is one of his favorite stocks. They are always reacting to old information and popular opinion, which means they are constantly buying from the independent thinkers who got there first and selling to them in a panic later on. This path guarantees that you will be a perpetual victim of the market cycles of boom and bust, forever transferring your wealth to those who have cultivated the discipline of rational, independent thought. The direct financial connection of independent thought is the creation of a margin of safety. This concept, also from Benjamin Graham, is the cornerstone of value investing. A margin of safety exists when you purchase an asset for a price significantly below your estimate of its intrinsic value. If you believe a business is worth $100 per share and you are able to buy it for $60, you have a $40 margin of safety. This gap between price and value is your protection against bad luck, errors in judgment, and the unpredictable vicissitudes of the economic world. It's the financial equivalent of building a bridge that can hold a 30,000-pound truck when you only expect to drive 10,000-pound trucks over it. How do you find this margin of safety? It is only available to the independent thinker. The market is generally efficient. Most of the time, the price of a stock is a reasonably fair reflection of its value based on all publicly available information. A significant gap between price and value, a true bargain, only opens up during periods of extreme emotion. It is the panic surrounding a salad oil scandal or a Watergate that creates the opportunity. The herd, reacting to the negative narrative, sells indiscriminately, pushing the price far below the rational value of the underlying business. Only the investor who has done their own work, who thinks independently, can recognize this gap and have the courage to step in and buy. The financial benefit is twofold. First, it dramatically increases your potential for upside. Buying at $60 what you believe is worth $100 provides a much greater return potential than buying it at $90. Second, and more importantly, it provides powerful downside protection. If your analysis was slightly wrong and the business is only worth $80, you still make a profit. If a recession hits and the value temporarily falls to 70, you are still ahead. The margin of safety is your shock absorber. In a portfolio, a collection of assets all bought with a significant margin of safety creates immense resilience. It becomes robust and anti-fragile. The financial advantage is not theoretical. It is the fundamental source of all superior investment returns. By cultivating the temperament of an independent thinker, you give yourself the exclusive ability to identify and act on these discrepancies between price and value. You are no longer just participating in the market. You are exploiting its emotional and psychological flaws for your own financial gain. This is how beating the market is actually achieved, not through superior prediction, but through superior rationality. Our fourth pillar penetrates even deeper into our own psychology, addressing the two most powerful emotions in finance, fear and greed. This pillar is emotional detachment and humility. It's the ability to acknowledge that you are human, fallible, and subject to powerful biases, and to build systems that protect you from your own ego. High intelligence can be a curse in investing if it's not paired with humility, because it can lead to overconfidence, the mother of all catastrophic mistakes. The most telling anecdote for this principle is not one of Buffett's successes, but his self-proclaimed biggest failure, the purchase of Dexter Shoe Company in 1993. At the time, Dexter Shoe was a profitable, American-based shoe manufacturer with a strong brand. Buffett was impressed by the business and its management. He fell in love with it. He was so confident in the deal that he didn't just buy it with cash. He bought it using Berkshire Hathaway's own stock, swapping 203 shares of Berkshire A, then worth $433 million for the company. This, he would later explain, was a monumental error. Soon after the acquisition, Dexter Shoe's competitive advantage began to erode. Low-cost foreign competitors decimated the American shoe manufacturing industry. The moat that Buffett thought Dexter had turned out to be a mirage. The company's profits evaporated, and eventually the business became worthless. The $433 million investment went to zero, but the real cost was far greater. Because he had used Berkshire stock to make the purchase, the true cost was what those shares would be worth in the future. Today, those shares would be worth well over $10 billion. It was a multi-billion-dollar mistake. Now, the anecdote isn't the mistake itself. Everyone makes mistakes. The lesson is in Buffett's reaction. He didn't hide it. He didn't blame the economy, or foreign competition, or the managers. In his annual letters to shareholders, he has written about the Dexter Shoe mistake repeatedly, for decades. He takes full, personal responsibility. He uses it as a teaching moment about the dangers of paying for a business with your own undervalued stock, and the difficulty of predicting the durability of a competitive advantage. This is radical humility in action. He has the emotional detachment to dissect his biggest failure, unemotionally, in public, without letting his ego get in the way. He doesn't suffer from the need to always be right. He is focused on getting the right outcome in the long run, and that requires acknowledging and learning from your errors. This humility is the antidote to the ego-driven investing that destroys so much wealth. It's the understanding that the market is a powerful and humbling force, and that no matter how smart you are, you can be wrong. This temperament trait, the ability to admit error and learn from it, is arguably more important than the genius that allows you to find great investments in the first place. Because without it, a single mistake, amplified by ego and overconfidence, can erase a decade of brilliant successes. The psychological underpinnings of this pillar are critical to understand. The first and most dangerous bias for intelligent people is simply called overconfidence bias. It is our tendency to be more confident in our own abilities and judgments than is objectively reasonable. A high IQ can be a potent fuel for this bias. Success in one domain, say medicine or law, can lead an individual to believe they have a Midas touch that will translate to investing, an entirely different and more complex domain. They overestimate their ability to predict the future and underestimate the role of luck and randomness. Closely related is the Dunning-Kruger effect, a cognitive bias whereby people with low ability at a task overestimate their ability, but it also shows that highly competent individuals can underestimate their own competence relative to others. However, in the realm of complex systems like the market, even experts are prone to massive overconfidence, believing they can control or predict what is inherently uncontrollable. Humility is the only cure. It is the constant nagging awareness that the future is uncertain and that your analysis, no matter how thorough, could be flawed. This is what drives the need for a margin of safety. You demand a discount not because you are certain you are right, but because you are certain you could be wrong. The other powerful bias at play is loss aversion. Behavioral finance studies have shown that the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $1,000 feels much worse than gaining $1,000 feels good. This asymmetry makes us do irrational things. It causes us to hold on to losing stocks for far too long, because selling would mean realizing the loss and admitting the pain of our mistake. Our ego and our loss-averse brain conspire to tell us, just wait, it will come back. Emotional detachment is the ability to override this powerful instinct. A detached investor views a losing position not as a personal failure but as a piece of data. They can ask objectively, knowing what I know today, would I buy this stock? If the answer is no, I should sell it, regardless of my original purchase price. This is zero-based thinking, and it is impossible without emotional detachment from past decisions. The combination of humility and detachment creates a powerful mindset for risk management. It allows you to kill your own bad ideas quickly, to take small losses before they become catastrophic ones, and to avoid the kind of bet-the-farm wagers that are born from an arrogant belief in your own infallibility. It is the psychological foundation for long-term survival in a game that is designed to expose and punish hubris. To turn this abstract concept into a concrete tool, we can borrow a powerful mental model from Buffett's partner, Charlie Munger, the principle of inversion. Instead of thinking forward about how to achieve success, you invert the problem and think backward about what could cause failure. Before making any major investment decision, you conduct what is known as a pre-mortem. A post-mortem is what doctors do after a patient has died to figure out what went wrong. A pre-mortem is an exercise in prospective hindsight. You imagine that it is 1 year in the future, and your investment has failed spectacularly. It has been a total disaster. Now, working with that assumption, you and your team brainstorm every possible reason for this failure. What went wrong? Did a new competitor emerge? Did the technology change? Was the management dishonest? Did a recession hit? Was your original analysis just plain wrong? This process is a powerful antidote to overconfidence and confirmation bias. When we are excited about an investment, our natural tendency is to look for evidence that confirms our thesis. The pre-mortem forces us to do the opposite, to actively search for all the ways we could be wrong. It gives us permission to be critical and pessimistic, which can be difficult in an optimistic, forward-looking culture. The step-by-step blueprint is simple but effective. Step 1. Clearly state your investment thesis and your desired outcome. I am investing in Company X because I believe its strong brand will allow it to grow earnings by 15% per year for the next decade. Step 2. Invert the problem. Announce to yourself or your team, we are now in the future. The investment in Company X has been a catastrophe, losing 50% of its value. Our task is to understand why. Step 3. Generate the reasons for failure. Brainstorm every conceivable cause, no matter how remote. List them all out. The more exhaustive, the better. This should include both external factors, economic, competitive, and internal factors, flaws in your own analysis. Step 4. Address the list. Go through your list of potential failure points and assess the probability and impact of each. Can you mitigate these risks? Does the potential reward justify taking these risks? In some cases, This exercise will reveal a fatal flaw you had previously overlooked, causing you to abandon the investment entirely. More often, it will allow you to proceed with a much clearer, more humble understanding of the dangers involved. You might adjust your position size or build in a larger margin of safety. This inversion technique is a practical way to institutionalize humility and emotional detachment into your decision-making process. It is a core component of elite executive decision-making and is absolutely essential for sound risk management in a portfolio. The antithesis of this humble, detached approach is the path of the ego investor. This is the investor who inextricably links their sense of self-worth to their portfolio's performance. When their stocks are up, they feel like a genius. They are quick to take credit for their successes, attributing them to their own skill and insight, a bias known as self-attribution bias. They become overconfident and start taking bigger and bigger risks. This is the story of many fund managers who have one great year, attract a flood of new money, and then blow up spectacularly by making leveraged bets based on the belief in their own infallibility. The classic example is long-term capital management in 1998, a hedge fund run by Nobel Prize-winning economists who believed their models made them invincible, only to nearly collapse the global financial system. When their stocks are down, the ego investor's reaction is just as destructive. Because a losing position is a direct assault on their ego, they cannot accept it. They refuse to sell and realize the loss, because that would be an admission of failure. Instead, they engage in rationalization. The market is just irrational. It's a long-term hold. They might even double down, buying more of the losing stock not because of a rational reassessment of its value, but as an act of defiance, an attempt to prove their original decision was right. This is emotional investing in its purest form. The decision to hold or sell is no longer based on the fundamental prospects of the business, but on the investor's internal need to protect their ego. This is a recipe for disaster. It allows small, manageable mistakes to fester and grow into portfolio-crippling losses. The ego investor cannot learn from their mistakes because they cannot even admit they've made them. Every piece of negative feedback is deflected. Every loss is blamed on external factors. Their mindset is fixed, not one of growth. This path is one of repeated errors. Because they never internalize the lessons from their failures, they are doomed to repeat them in the next market cycle. They are the opposite of Warren Buffett with his Dexter shoe story. While Buffett uses his mistakes as a tool for self-improvement and teaching, the ego investor buries them, ensuring that the same character flaw will emerge to wreak havoc again and again. The direct financial connection of emotional detachment and humility is capital preservation. Investing is a two-part game, offense and defense. Humility is the cornerstone of a great defense. By forcing you to confront the ways you could be wrong, it leads you to demand a larger margin of safety, to diversify your bets, and to avoid using excessive leverage. It prevents you from making the one single bet that can take you out of the game entirely. Imagine a brilliant investor who, through skill, turns $100,000 into $1 million over 5 years. Filled with hubris, they then concentrate that entire million into a single, high-conviction idea with a little bit of leverage. If that one idea goes to zero, their brilliance and years of hard work are rendered meaningless. They are back to square one, or worse. Humility prevents this. It whispers in your ear, "You might be wrong about this one. Maybe don't bet the entire farm." From a portfolio management perspective, this translates into sensible position sizing. No single investment, no matter how great it seems, should ever be so large that its failure would jeopardize your long-term financial goals. On a personal balance sheet, the financial benefit is avoiding the zeros. A portfolio can recover from a 10% or 20% drawdown. It is mathematically almost impossible to recover from a 90 or 100% loss. Emotional detachment, specifically the ability to overcome loss aversion, also has a direct financial benefit. It allows you to sell a mistake when it is still a small mistake. By cutting a losing position that has violated your original thesis, you free up that capital to be redeployed into a more promising opportunity. The ego-driven investor, by contrast, lets that capital sit in a dead money stock for years, hoping to get back to even. The opportunity cost is immense. The money trapped in that losing position could have been compounding elsewhere. In essence, humility and emotional detachment are the traits that ensure your long-term survival. They are the financial governors that protect your wealth from your own worst enemy, your ego. They guarantee that you will live to play another day, and in the game of compounding, survival and longevity are the ultimate sources of victory. Finally, we arrive at the fifth and culminating pillar of the Buffett temperament, the one that ties all the others together, a long-term perspective. This is not just about being patient. It is a fundamental worldview. It is the ability to think in decades, not days or quarters. This allows an investor to exploit what is perhaps the single greatest inefficiency in modern markets, the time horizon arbitrage. The story that best captures this is the 1972 acquisition of See's Candies. On the surface, it seemed like a strange purchase for a value investor like Buffett. He and his partner Charlie Munger paid $25 million for a company that had only $8 million in tangible assets. This meant they were paying a significant premium over the book value, something that went against the grain of traditional Graham-style value investing. Many analysts at the time would have called it expensive, but Buffett and Munger weren't just buying the factories and the inventory. They were buying the next 50 years of the See's Candies brand. They had the long-term perspective to see what the market was missing. They understood that See's had a powerful, intangible asset, a deep and abiding emotional connection with its customers, particularly on the West Coast. For generations, a box of See's was a gift for Valentine's Day, a staple at Christmas, a treat for Mother's Day. This brand loyalty gave the company tremendous pricing power. Every year, they could raise their prices slightly to cover inflation and then some, and their customers wouldn't blink. It was an affordable luxury. This created a business that was a cash generation machine. It required very little new capital to grow, and it spewed out cash year after year. Buffett and Munger realized they were not buying a static set of assets for $25 million. They were buying a perpetual royalty on the happiness and traditions of millions of families. A short-term thinker would have looked at the price-to-book ratio and passed. A long-term thinker saw the incredible value of the brand's durability. The results speak for themselves. That $25 million investment has since returned over $2 billion in pre-tax profits to Berkshire Hathaway, profits that required almost no additional capital investment. It became the prototype for the kind of business Buffett would look for in the future, companies with durable moats that could be held seemingly forever. The See's Candies story is the ultimate example of time horizon arbitrage. Buffett and Munger were able to buy a phenomenal long-term asset at a reasonable price because the rest of the market, with its focus on the next quarter's earnings, was incapable of properly valuing its decades-long potential. Their temperament allowed them to see a future that others were too myopic to imagine. The psychological bias that creates this massive market inefficiency is a combination of myopia and recency bias. Myopia, in a financial context, is extreme short-sightedness. The entire structure of the modern financial world encourages this. Professional fund managers are judged on their quarterly and even monthly performance. Financial news provides a minute-by-minute commentary on market fluctuations. Companies are pressured to meet quarterly earnings estimates. The result is an ecosystem where the vast majority of participants are making decisions with an incredibly short time horizon. Recency bias is our tendency to overweight recent events and to project them indefinitely into the future. If a company has a few bad quarters, the myopic market assumes the company is in a permanent decline. If an industry is facing a temporary headwind, the market prices it as if that headwind will last forever. A long-term perspective is the direct antidote to these biases. It allows an investor to step back from the frantic noise of the present and assess the fundamental long-term trajectory of a business. When a great company like See's Candies has a slow Christmas season due to a weak economy, the long-term investor sees a temporary blip and a potential buying opportunity. The short-term market sees a disaster and sells. This difference in perspective is the quote-unquote time arbitrage, You are essentially leveraging your ability to be more patient than other market participants. They are playing chess, thinking one or two moves ahead. You are playing a different game entirely, thinking about the board's configuration 10 years from now. This psychological shift is profound. It changes what you look for in an investment. You stop worrying about next quarter's earnings per share and start asking more important questions. Does this business have a durable competitive advantage? Is it in a structurally sound industry? Does it have a culture that can adapt and thrive over decades? Can it reinvest its earnings at a high rate of return? These are the questions that matter for long-term wealth building. By cultivating a long-term perspective, you are fundamentally changing the game you are playing. You are removing yourself from the zero-sum, high-speed trading game played by the majority and entering into a positive-sum game of long-term business ownership. You are aligning yourself with the forces of economic progress and value creation, rather than trying to scalp small profits from the market's random noise. How do you develop this long-term perspective in a world that bombards you with short-term stimuli? You must build a mental model of thinking in decades. This requires a conscious effort to zoom out and change the scale of your analysis. Here is a blueprint for cultivating this mindset. First, change your information diet. Drastically reduce your consumption of daily financial news. The minute-to-minute market commentary, the expert predictions, the breaking news alerts, these are all toxins to a long-term mindset. They are designed to trigger an emotional, short-term reaction. Instead, replace this with a diet of business history, biographies of great business leaders, and annual reports of companies that have endured for 50 years or more. Study the history of Coca-Cola, not the daily price of its stock. This will train your brain to recognize the patterns of long-term success and durability. Second, when analyzing any potential investment, your first question must be, what is the probability that this business will be bigger and more profitable in 10 years and then in 20 years? This question forces you to look past temporary problems and focus on the fundamental drivers of long-term value. For many companies, especially those in rapidly changing technology sectors, the honest answer is, I have no idea. That's a sign to move on. For a business with a powerful brand, a simple product, and a long history of stability, the answer becomes much clearer. This is a core part of achieving financial freedom, owning assets that work for you over decades, not just days. Third, align your actions with your time horizon. If you are a 30-year-old investing for retirement, your time horizon is 30 to 40 years. Why, then, would you check your portfolio's performance every day? It's like planting a sapling and digging it up every morning to see if the roots are growing. Your actions are misaligned with your goals. Create a rule for yourself. I will only check my portfolio performance once a quarter, or even once a year. This deliberate friction forces you to detach from the short-term noise and focus on the long-term journey. Thinking in decades is not a passive act, it is an active discipline. It is a conscious choice to ignore 99% of the information thrown at you and to focus only on the small fraction that matters for the very long run. It is the ultimate expression of a superior investment temperament. The antithesis of this long-term perspective is the path of the 99%, which is an obsession with the short term. This is the world of the high-frequency trader, whose time horizon is measured in milliseconds. It is the world of the hedge fund manager who lives and dies by their quarterly performance numbers. It is the world of the retail investor who is glued to the earnings calendar, trying to guess whether a company will beat or miss analyst estimates by a penny. This entire ecosystem is built on the false premise that the short-term future is predictable, and that outsmarting others in this prediction game is the path to wealth. The reality is that the short term is almost pure randomness, a random walk as economists call it. Trying to predict it is a fool's errand. The obsession with the short term leads to a host of destructive behaviors. It encourages overtrading, as investors constantly reposition their portfolios based on the latest news or rumor. This racks up transaction costs and taxes, creating a significant drag on returns. It causes investors to sell great companies for foolish reasons. A wonderful long-term business might miss its quarterly earnings estimate because of a one-time factory expense. The short-term obsessed market will punish the stock, selling it off 10% in a day. The long-term thinker sees this as a gift, a chance to buy more of a great company at a discount. The short-term thinker, however, panics and sells, crystallizing a loss and missing out on the decades of future growth. This mindset also leads to a fundamental misvaluation of assets. The market becomes very good at pricing what a business will earn in the next 90 days, but very poor at pricing what it will earn over the next 90 months or 90 quarters. The durability of a brand like See's Candies or the global reach of a company like Coca-Cola is an asset whose value unfolds over decades, and it is consistently undervalued by a market that is myopically focused on the immediate future. The path of the short-term thinker is one of constant stress, high costs, and poor performance. It is a game that is heavily stacked against the individual investor. You cannot be faster than the supercomputers of high-frequency trading firms. You cannot know more than the thousands of analysts dissecting every quarterly report. But you can have a longer time horizon than almost all of them. Your patience is your one great structural advantage. The 99% squander this advantage by trying to play a game they cannot win. The direct financial connection of a long-term perspective is the ability to capture the two most powerful return drivers in all of finance: the true, long-term compounding of business value and the equity risk premium. First, let's look at business value. A stock is not a lottery ticket. It is a fractional ownership of a business. A great business, over time, increases its intrinsic value by retaining its earnings and reinvesting them in projects that generate high rates of return. This process of internal compounding is the ultimate source of stock market wealth. By holding a stock for a short period, you are merely speculating on a change in the market's sentiment. By holding it for decades, you become a direct beneficiary of the underlying business's value creation. Your financial returns start to mirror the growth of the business itself, rather than the random whims of Mr. Market. You are transforming yourself from a speculator into a business owner. Second, the equity risk premium. Historically, stocks have provided a much higher return than less risky assets like bonds or cash. This additional return is the equity risk premium. It is the compensation investors demand for taking on the short-term volatility of the stock market. The crucial point is that you only get to harvest this premium if you are willing to endure the volatility. A long-term perspective is what allows you to do this. You understand that market crashes are a normal, recurring feature of the investment landscape. You see them not as a threat, but as the price of admission for earning superior long-term returns. The short-term investor experiences the volatility as risk and pain, and they often sell at the bottom, locking in losses and failing to capture the premium. The long-term investor experiences the same volatility as a temporary fluctuation, holds firm, and is ultimately rewarded with the full, historically robust returns that equities provide. The financial advantage is immense. By simply extending your time horizon, you give yourself access to a higher class of returns. You benefit from the steady, powerful engine of business growth, and you are compensated for providing the patient, long-term capital that the market needs. It is the closest thing to a free lunch in finance, but the price of that lunch is the emotional and temperamental fortitude to think and act for the long term. You have now been given the complete architecture of a market-beating temperament. We have deconstructed the 5 core pillars: the predatory patience to wait for the perfect pitch, the unwavering discipline to stick to your rules, the lonely courage of independent thought, the essential humility to protect you from your own ego, and the profound perspective to think in decades, not days. This is not just a collection of nice ideas, it is a cohesive operating system for rational decision-making in the face of uncertainty. You now possess the knowledge to transform your own psychology from your biggest financial liability into your most powerful and enduring asset. You understand that the game is not won by the person with the highest IQ, but by the person with the most control over their own emotions. This framework is the foundation upon which all lasting wealth is built. But a foundation, no matter how strong, is only the beginning. A superior temperament tells you how to behave, but it does not, by itself, tell you what to buy. It is the psychological engine, but that engine must be connected to an analytical chassis, a set of tools for valuing businesses, for reading financial statements, and for identifying the very wonderful companies that this temperament allows you to hold. Mastering the mindset is the first and most important half of the equation. The video that is now appearing on your screen is the second half. It is the bridge from the times why to the times how. It is the missing link that connects a rational mind to a rational portfolio. It takes the principles we have discussed today and translates them into the language of numbers, of balance sheets and income statements, of moats and margins of safety. Most people will stop here, satisfied with the psychological insights. But the true student of success, the individual who is genuinely committed to architecting their own financial future, understands that this is a journey of interconnected knowledge. They know that the next piece of the map is just as crucial as the last. The choice to click is not a choice to watch another video. It is a declaration. It is a commitment to continue your ascent, to complete your mental arsenal, and to transform this powerful knowledge into a tangible and lasting financial reality. The next step of your journey is waiting.